Every headline asks the same question about artificial intelligence stocks, and it's a yes or no. Is this a bubble? That framing is the trap. Because the most honest answer is partly, and partly a bubble is a very different thing from worthless. The real question was never whether AI is a bubble. It's whether the prices being paid for it will ever be justified, and how much it hurts when the gap closes. Start with what a bubble actually is. It's not just a high price. It's a price that has detached from underlying value and keeps climbing mainly because people believe someone else will pay more later. The technology is often real. The internet was real in 1999. What makes it a bubble is that the price stops being about the business and starts being about the next buyer. By that definition, the AI trade has some genuine warning signs. Start with concentration. A small handful of giant technology companies now make up about a third of the entire S&P 500, roughly the same top-heavy concentration the market carried at the peak of the dot-com bubble in 2000. When that few names hold that much of the index, a stumble in one corner drags down everything. Then there's circular financing. A chipmaker invests in an AI startup. The startup uses that money to buy the chipmaker's chips. The chipmaker books the revenue. Cash flows in a loop among a small group of players, and demand that looks external is partly the industry funding itself. That loop looks healthy while capital is flowing, and turns fragile the moment it slows. And there's the return gap. Companies are spending hundreds of billions of dollars a year building AI infrastructure, but the measurable payoff is lagging badly behind. One widely cited MIT study last year found that the large majority of enterprises weren't yet seeing a real return on their generative AI spending. The spending is a fact today. The return is still a forecast. But here's why this isn't a simple replay of the dot-com crash. The companies leading it are, for the most part, real businesses with real revenue and real profits, funding the build-out out of actual earnings rather than selling a story to raise the next round. The valuations are stretched, but not unhinged the way 2000 was. The broad market trades in the mid-20s times earnings today, where the tech-heavy NASDAQ hit around 60 times at the 2000 peak. Expensive is not the same as delusional. And the technology genuinely works, and is genuinely being adopted, which was far less true of most 1999 dot-coms. So you've got classic bubble symptoms sitting on top of a real profitable working industry. The frame that fits best isn't bubble or no bubble, it's closer to what Jeff Bezos called an industrial bubble. In an industrial bubble, the technology is real and transformative, but the market still overpays for it in the short run. Capital gets wasted, weaker companies fail, prices correct hard, and yet the infrastructure that gets built survives and ends up mattering enormously. The cautionary tale is Cisco, a real company selling real plumbing for the real internet, whose investors at the 2000 peak were right about the future, wrong about the price, and underwater for the better part of 2 decades. So what actually decides which way this breaks? Not whether AI is real. It is. It's whether the price being paid gets recouped, and on what timeline. The things worth watching are the ones that close the gap between spending and return. Whether all that AI capex shows up as faster revenue and fatter margins at the companies doing the buying, whether the circular financing keeps flowing or seizes up, and whether the market can stop leaning on a handful of names. A sharp drop in the most expensive corner, the kind the chip names just delivered, is exactly what the early innings of that repricing look like. So, is the AI trade a bubble? The useful answer is that it can be overpriced and real at the same time. And both halves of that sentence are true right now. The mistake isn't believing in the technology. It's confusing being right about the future with being right about the price. Those are two different bets, and only one of them shows up on your statement. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.